Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Independent Bank Corporation Annual Report. Independent Bank Corporation offers a wide range of financial services to its customers. At the core of its operations are traditional banking services, including demand deposits, interest checking, money market accounts, savings accounts, and time certificates of deposit. The company also provides consumer loans, such as residential mortgages and home equity loans, which are secured by 1 to 4 family residential properties. In addition to these basic services, Independent Bank Corporation offers a variety of investment and financial services. These include cash management, investment management, trust services, estate settlement, financial planning, tax services, and other special services. The company also sells mutual fund shares, unit investment trust shares, third-party model portfolios, general securities, fixed and variable annuities, as well as life insurance products. The bank services are not limited to traditional banking channels. It offers debit and credit card services, safe deposit box services, automatic teller machines, ATMs, and internet and mobile banking services. These modern amenities enable customers to manage their finances conveniently and securely from anywhere. With a rich history dating back to 1864, Independent Bank Corporation has established itself as a reliable financial institution in the United States. The stock price of Independent Bank Corp. (IBCP) has experienced significant growth in the past year, increasing by 11.54% to 11.26%. Several key news events have contributed to this upward trend, including a dividend increase, strong financial results, and strategic acquisitions. One of the primary drivers of IBCP's stock price appreciation was its acquisition of Enterprise Bancorp, Inc. In July 2025, this move not only expanded the company's market presence, but also led to improved financial performance, with a 25 basis point increase in net interest margin to 3.62%. The company's Q3 2025 results showcased growth in wealth assets under administration and an improved operating efficiency ratio. In addition to its acquisition, IBCP has also demonstrated its commitment to generating long-term returns for shareholders through consistent dividend increases. In March 2025, the company announced a 4% increase in its quarterly dividend to $0.59 per share, payable on April 7, 2025. This move was followed by another dividend increase in January 2026, with a 7.7% hike in its quarterly cash dividend. Furthermore, IBCP's Board of Directors authorized a share repurchase plan for 2026, allowing the company to buy back up to 1,100,000 shares, approximately 5% of outstanding shares. This move signals confidence from management and can boost shareholder value by reducing the number of outstanding shares. The company's strong Q4 2025 earnings also contributed to its stock price appreciation. IBCP reported an EPS of $0.89, surpassing expectations and reflecting improved financial performance. Overall, these collective positive announcements have likely contributed to the periods of significant stock price appreciation experienced by Independent Bank Corp. In the past year, the income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in financial institutions can be attributed to a combination of factors. On the positive side, loan and deposit growth, interest and fees on loans, and net gains on mortgage loans are key contributors to revenue growth. However, there are several drivers that can lead to revenue decline. These include declines in customer industries, increased credit losses due to economic conditions and supply chain factors, and failure to accurately determine demand for banking and financial products. Additionally, the inability to utilize technology efficiently and effectively, disruption from emerging digital assets and technologies, competitive product and pricing pressures among financial institutions, changes in customer behavior, economic conditions, consumer confidence levels, and catastrophic events can all impact revenue negatively. In essence, revenue growth is largely driven by traditional banking activities, such as lending and deposit taking, while revenue decline is often the result of external factors beyond an institution's control. Net income experienced fluctuations over the period in question. Initially, it remained unchanged, but later decreased due to various factors such as reduced net interest margins, potential increased credit losses, and liquidity pressures. Additionally, compliance with capital requirements, declines in customer industries, failure to accurately determine demand, inability to utilize technology efficiently, and disruption from emerging digital assets also contributed to the decrease. Profit margins followed a similar trend, decreasing over time. The primary reasons for this decline were reduced net interest margins, potential increased credit losses, and liquidity pressures. Furthermore, the shift towards digital assets and technologies led to a reduction in deposits and payment-related revenues, while increased competition from non-bank providers and larger technology firms also played a significant role in the decrease of profit margins. Management is expressing a cautious outlook for the company due to various challenges and uncertainties. They anticipate continued declines in customer transaction volume at bank offices, but expect an increase through electronic channels. The company must balance its financial performance with regulatory requirements, including maintaining minimum capital levels and ratios. One of the key concerns is the impact of new legislation on operations, which is uncertain. Economic uncertainty and macroeconomic pressures may also affect the company's financial condition and performance. Additionally, management acknowledges that it may not be able to effectively mitigate risk exposures, which could have a material adverse impact on the business. The company faces several risks, including liquidity risk due to potential inability to meet obligations and capitalize on growth opportunities. Cybersecurity risks are also high, posing significant reputational damage, loss of customers, and financial losses. Management is taking steps to limit credit losses by purchasing highly rated securities and conducting due diligence on issuers. Overall, management's strategy appears to focus on maintaining regulatory compliance, managing risk exposures, and adapting to changing market conditions. They aim to be an employer of choice while continuing to invest in community development and reinvestment in the areas they serve. Acquisitions and divestitures. Key takeaways. The extracted summaries reveal several key acquisitions and divestitures that have been identified. On the acquisition side, it is clear that banks are expanding their reach through various means. This includes the acquisition by a bank holding company of voting shares in another bank, resulting in direct or indirect ownership/control of more than 5% of any class of voting shares. Additionally, mergers and consolidations between existing bank subsidiaries are also taking place. Furthermore, bank subsidiaries are acquiring assets from other banks and assuming deposit and other liabilities. This expansion is not limited to within-state transactions, as Michigan banks are being acquired by FDIC-insured banks or savings banks located in other states. Moreover, consolidation of Michigan banks with out-of-state institutions having laws permitting such consolidation is also occurring. In terms of divestitures, the summaries highlight several key restrictions and requirements. These include requiring senior executive officers or directors to be dismissed, restricting transactions with affiliates, and mandating the divestiture of certain subsidiaries. Additionally, Michigan banks are being required to sell branches to out-of-state FDIC-insured banks or savings banks in specific circumstances. The company has a history of paying dividends to its shareholders. This practice indicates a commitment to returning value to investors through regular distributions. The payment of dividends is mentioned in various sections of the document, emphasizing its importance as a source of funds for both operating expenses and shareholder returns. That concludes the financial summary for Independent Bank Corporation. Feel free to comment below, and I will be happy to answer them when possible.